Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Cressman, and I am joined here with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing good, Seth. I'm doing real good. How you doing, Dan?
I'm feeling good. Feeling strong, just like the start to this year.
Ouch.
Folks, glad to have you aboard with us today. If you're new to Money on Tap, well, we are going to be talking about three-dimensional investing. All three of us are financial planners with Brayshaw Financial Group. And one of the things we love to do is to help educate and really, elevate the temperature in the room for everyone so that we can just have great conversations about successful investing and bringing all things of the industry to bear for you so that you can have that insight and that understanding of how to move forward. Today, the topic is Sizzle or Fizzle in 2023. What are the markets going to do? You know what? The glass ball is coming out today, folks, and we're going to have a little bit of, you're going to have to hold on and wait and see what it's going to be. But I'm excited about this show.
I think there's so much diversity in opinions of the stock market right now, and watching it rally, and the Fed's decision to raise a quarter point, and there's a lot of moving parts here. I was actually really surprised, based on a few comments made by Chairman Powell, just in the idea of the quarter point, in saying things to the effect of like, we still want to see 2% inflation. To see 2% inflation, you know how far below 2 we need to get to to make the average 2 over a 12-month period right now? We're talking 6 months of below 2 at least, or more.
And, I couldn't believe it listening to his last press conference. They actually used the word transitory again. I was like, I thought they had stricken that from the dictionary.
I think the second you hear anybody say transitory, just say, I'm in the middle of a lie, and I just need to say it.
Yeah. Red flags there, folks. Red flags.
Transitory. Oh, my goodness gracious. I'm so tired of... they should have raised a half a point. They talked about they don't like these big, huge swings in the market. They wanted a more calm market, and yet, the market takes off the second he says a quarter point. I thought for sure that they were going to do a half a point. I felt like they were, but to be going three quarter, and then quarter point, it's like...
the market must have rallied 5% since they declared it, right?
In 30 seconds.
Yeah, it's fictional.
Yeah, it's ridiculous. So the idea of all this stuff is just, it's crazy. We've got a lot to talk about with the market for sure.
Well, all right. We are going to take a couple of minutes here to jump into Money in the News.
The first article we get today is coming to us from wealthmanagement.com. This is from Anna Sulkin. In the article, the title's funny, right? All shook up. What's left in Lisa Marie Presley's estate? Now, it's a catchy title, and everyone has got fond memories of Elvis, but kind of what's going on with what he left behind is bordering on tragic here. There's not a lot of great news in that article, but there's a lot of things that we can use as kind of a cautionary tale as to how to better prepare your estate. Because as it comes out, she just died tragically here at age 54, so too young to be leaving us.
Two young twins at 14 years old.
Oh,
yeah, it's horrible.
That's horrific. And on top of it, we come to find out here in the article that in 1993, when she was just 25, she inherited $100 million from Elvis's estate. Which what fantastic wealth! So young and to have all that money coming in. But what's gone on since then is just, it's really out of control. It's not great. Just a kind of a cautionary tale on mismanagement and overspending, and just kind of being ill-prepared to, make that wealth last for as many generations as it should have.
I think in reading through this article, and I thought it was really the author made some really good points, but the idea that it's really the tragedy of the wealthy over again and over again played. I mean, she died with $16 million in debt. She was suing her longtime financial manager for mismanagement. They gave up rights to lots of different companies they owned, and just all sorts of things that they had done. It looks horrendous, but it doesn't leave the children, the three kids, without a decent inheritance, including Grace. It was Graceland, right?
Graceland, yeah.
So there's still quite a bit there for the inheritance, but I mean, as for all of us on this on this podcast, but and it scares me too, because two young kids, 14 years old, it's just like you just know you're going to hear 20 years from now that they got taken advantage of for their wealth. Meanwhile, while sitting in,
it's just something about the celebrity circles that just tends to happen
over and over again.
You really just got to wonder why. I mean, obviously there's vultures circling, and there's people out there to take advantage of novices and people that aren't experienced in this. But somewhere along the way, I think these people would just find good counsel. And
I think I could probably make the online statement of, like, if you're a super wealthy person, inheritor of somebody, I can manage your money and assets for half of what anyone's charging you, and it would still be more.
And you can trust it. Folks.
You know what I mean? Like, every one of them's like, well, whatever they charge, they charge. It's just sad.
According to this, at the end, she was down to $95,000 in cash and about a little over $714,000 in investments, but her expenses were $92,000 a month. I mean, she had less than a year's worth of available cash when she went. I mean, that's after inheriting $100 million in 1993. To be left with that is really incredible.
Well, I think, and who knows what the income is from Graceland for her and stuff like that. But I thought it was funny that her rent was $23,500. What was she renting?
Yeah, I mean, you own Graceland. It's outright. You have it. You don't need to rent there.
Like, I mean, I don't know. You inherit $100 million, you go buy a house.
Something.
You could buy a couple houses.
Yeah, she's got, I think it was at least Maserati too. Like, there's just no good counsel happening there.
No, not at all. But who knows what she wasn't willing to take either.
That's true. I guess we're supposing she didn't get good advice. Maybe she got good advice and just didn't listen.
Yeah.
Who knows?
But we'd still charge half as much.
Yeah.
A hellish hat trick. This ultra-rich New York family lost billions in Enron, Bernie Madoff, and now FTX. So here are 3 simple tricks to avoid getting scammed yourself by Amy Leggett-Wolf. Thank you very much for this read. And holy cow, that's not the hat trick that I would hope our families would experience. Unbelievable to be caught in 3 of the largest ever Ponzi schemes that we've ever come across.
Yeah, really unfortunate. The whole adage, fool me once, fool me twice. Well, fool me 3 times. Like, another guy that needs some advice here.
Just go buy a blue chip.
Seriously. Or buy nothing. Bury your money, and leave a map. But, it's utterly incredible that somebody would find themselves 3 times over in, like, the largest financial frauds in the history of the world. I mean, we did a show on this, and this guy's covered them all.
We should just call him to come in and be a guest speaker.
Yeah, you almost have to be looking for him at this point. Truly incredible, but this family has certainly suffered. I mean, as it stands right now, and I don't know how you survived the first 2, but he stands to lose $34.5 million in this FTX scam.
I just can't.
After he lost tens of millions to Madoff and billions to Enron.
I get Enron. I mean, like, okay, Enron took so many people.
Sure.
I mean, so many people, and it was an energy company, and I can't really blame somebody for losing money in Enron.
Lots of people there, and there's the article actually dives in, with FTX, Bob Kraft and Tom Brady got caught up in that.
But and then Madoff, like, I can't really blame a lot of people with Madoff. Like, some of the biggest banks in the world bought into Madoff. When you come to FTX, like, at that point in time, you're like, listen, I've been scammed by 2 what I thought were legitimate sources. I'm definitely not going to digital currency investments.
Madoff had everyone fooled. I mean, he was the chairman of NASDAQ. I mean, it's truly incredible. And, I made reference to it before, and there's the Netflix series out there about it, which, for us in the business is just a great watch because, we go through this vigorous compliance on a regular basis. I mean, it is left, right, and center. It's
One guy we
24 hours a
supervised was
day.
complaining because he's been audited 3 times in like a month and a half by 3 different organizations. He's like,
And this guy's running a $500 million firm in the 80s, which is a lot of money, and he wasn't even registered as an investment company, which is just like the beginning of it all. It's virtually impossible to have all these auditors coming in and out, and they never ran a broker check on the guy. I mean, it's like the simplest thing you could possibly do. And all this money coming through his hands and never invested a nickel of it. It's really incredible. But another cautionary tale here, and the article points to a couple simple things you can do to just kind of protect yourself and verify who it is that you're dealing with. And the first one is to make sure that the entity is registered, right? We're all licensed. Finding information about us and the organizations we represent is really super easy to do. And it takes you all of 5 minutes, and you just really need to take that step.
I mean, if the person's registered, at least they're getting audited. You know that all these things are happening. People have to go. I mean, there's this whole compliance requirement behind everybody who's registered. So if they're not registered, and like you said, Dan, it's literally a minute. Oh, yeah, he's a registered individual in the investment industry. Like, it's not that complicated. And if you're not doing that at all, like, that is a real problem.
I mean, if you take the steps to just do that, you'll immediately see if they have a history of customer disputes and disciplinary actions. So it's not a simple matter of are they registered properly, but you'll also see it's essentially like the principal's office, your permanent record. When and where have you gotten into trouble, if at all, and it's all right there.
Yeah, I know. And the next one I think is really, really important. It's something that I actually have to say to myself, which is like, and I don't use the FOMO, fear of missing out acronym in my head, but, don't go racing because you think like, we were talking about that stock today. I was like, I'll just wait. Market's rallying, things are happening. I'll just wait because I really do think the market's going to pull back and there will be some real opportunities. So that being said, Don't just race to whatever investment is the latest, greatest thing, and you hear somebody made a ton of money, and it's like, what GameStop was up $280, $300. I don't know. It's crazy. It's like $20 now. I mean, every person that made money, there's just as many people that lost it.
Oh, more. I would say more. I mean, I still view some of those online forums, and it's there's still people out there trying to rally the stock. I'm like, you've got to be kidding me.
They're rallying it because they want to get out of it.
They're trying to get you to buy so they can sell.
Yeah. One of the other things was to get it in writing. So any legitimate investment opportunity, they're going to want to have a lot of people investing. So what do they have to do? They have to make sure that there's documentation and it's easy enough for you to be able to read and understand what they're saying. Also, if there's some outrageous claim like a guarantee of a X% return, unless it's in, the form of a CD or a money market or a bond or something like that that's issued, an equity investment should not have any claim to guarantee. So there's some cautions in there. Read through it. Make sure you understand it. Be very clear, and then also ask questions. You just be prepared. Write a list of what's important for you to understand, and run it by your financial advisor. Give us a call. We'll be happy to probably save you, like Ben was talking about, lots of money to be able to understand what's going out the door and what should be coming in.
It's one of the tactics that I actually saw, again, back to the Madoff Netflix show, and I don't know if these are actual quotes or not, but one of the things he would do as a habit is if he got challenged by somebody over the phone, one of his clients, to say, well, how are you making so much? Or, why are all the rest of my accounts not performing like yours? Or they had any kind of inkling of a dispute with them, he would simply say, hey, you want your money back? And he would, go through the motions as if he's about to send you a check. And time again, people would say, oh, no, you can keep it. And he would scare him off from asking questions with that simple enough tactic, and half these people, I'm sure, got swindled in the end.
Yeah, that's really sad. Yeah, no, I think that's important. Everything you should be able to see, and I tell clients all the time, because there are guaranteed products in the securities world. They have, and there's all sorts of stuff out there. CDs, we can give you everything in writing. That's important. You should have no problem getting your documents in writing.
It's something you said to me long ago, and I forget what we were talking about, but the phrase always stuck in my head. It's trust with verification.
Yeah,
right? You can trust what I'm saying, but verify it too.
Yeah, exactly.
Take your own responsibility.
I actually took that from my father-in-law, who's a pastor.
With a shotgun in his lap.
Yeah, trust with verification, Ben. Yeah, no, very wise man. Very wise man. Next up, we got Pfizer forecasts big drop in revenue after record $100 million COVID-led haul of money. This is from the New York Post, and it's by Reuters. What's really amazing is that Pfizer crossed the $100 billion mark for the first time in 2022, driven by more than $56 billion in sales of its COVID-19 vaccine, which is crazy. But, it's funny, Pfizer's pulled way back in its stock, and it's all because they're expected to do only between $67 billion and $71 billion this year, which is a significant downfall from its COVID craze.
Yeah, it seems as though its sales have crested, although they do take the time to anticipate or state that they anticipate growth again in 2024. And it's not to say that they're a one-trick pony, but clearly the COVID vaccine is the lion's share of what they do in terms of business.
Yeah, and there's a number of other moving factors here. It's not just the decline in COVID boosters and things like that. It's they have a number of drug patents that are going to expire in 2025, which has a lot to do with its cancer and arthritis treatments. So that's when those can become commonplace drugs that everyone can market, you're going to lose some money. So that's a big deal in that space.
Yeah, they've launched 5 new products over the last year and are anticipating 14 more over the next year and a half. Of those that they launched, it was interesting to see that Syncytol, or the RSV cure or antiviral, as well as an RNA flu vaccine. Just interesting if you're kind of in that conspiracy mindset, that would be something that would poke the bear a little bit.
Yes, it would.
Yeah. So one of the ways they're onboarding a lot more of their they're in a strong equity position right now, and they're talking about basically bringing a lot more treatments to the market. And one of the ways they're doing that is through acquisition. Acquiring other companies that have really built up a pipeline. They acquire it becomes their pipeline. So, yeah, I don't see Pfizer going anywhere, but it's an interesting hit that they've taken, and really interesting to see a rollover of this COVID vaccines just not being as popular as they once were. Folks, you are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking today about Sizzle or Fizzle in 2023. What is the market going to do? We're going to have some fun. Don't go anywhere. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, today we are talking about the market. Is it Sizzle or Fizzle in 2023? We have seen a lot of changes in 2022. And with that, a lot of surprises coming up in 2023 with the markets being up almost 20%, depending on what you are holding in your portfolio right now. This is something that has happened historically. We're going to talk about what the history of the market is after a big pullback. And we're also going to talk about where we feel the opportunities still lie if you feel like maybe you've missed this return in the market.
Yeah, I mean, if we look at what January's done for us, and we're here recording in early February, but the Dow was up 3%, the S&P up 6%, and the NASDAQ up 11%, which, coming off of where we ended last year and kind of what the sentiment was in the market, it certainly got a lot of people kind of scratching their heads as to, what is driving this rally in, a time where it was supposed to be fairly bleak. But I think there's a couple things that we can look at that are really, leading indicators as to where the kind of the optimism is coming from. And that's, primarily been the Fed's latest move, right? So they've been increasing at 75 basis point increments, basically all throughout last year. And this year, for the first increase, it was only 25 basis points. And there's a couple other, indicators in the world of inflation that have people feeling like, well, maybe that time is coming to its end and we're going to return to the prior normal. But the fact of the matter is, inflation's still high relatively compared to what it's historically been at. It was still not really anywhere near where the Fed's got targeted for an inflation rate.
Listening to Powell speak, it makes me really nervous watching the market bounce. I mean, they've mentioned over and over again they don't like the market having these huge swings. They want to calm down the market. They think it's unhealthy. It's not good. It's interesting that they, free trading marketplace, they want to still control.
Right.
I think that's an interesting perspective. And it's important for us as investors to know that there are people that are intentionally trying to manipulate the market, because that's what they're doing, right? Like, you can go to jail for manipulating the market, but if you're the Fed, you don't. Those are concerning factors for me, because if they have a goal and they do control the money movement in this country, and at the rate at which they charge for it, it becomes a very concerning issue long term. I mean, ultimately, you talked about wanting inflation to be around 2%. I mentioned this earlier in the show. The idea that how are we going to take a 6.5% inflation rate, or around 6%, and say bring that thing under 2% or 2% as an average over a 12-month period with all these higher months behind us? It's going to take years to get there.
And the fact of the matter is, I mean, they did increase the rate again, and people are reacting like it was a decrease. I mean, it's just because it wasn't as painful as the prior 6 or 7 were.
Well, and this. I mean, there was a lot of people that were saying that, this really presents a sentiment that they could have rate decreases coming a lot sooner. And they're kind of like there's some health, I think, to not jacking in another 0.5% in the idea of seeing how much carries forward from the changes they've already made. Because everything they do is a rear view mirror perspective, right? They're always looking backwards. They're trying to project forward, looking backwards. And it takes time for all this stuff to trickle down. I think the trickle down is going to be a lot worse than they realize. And the outcome of this stuff is going to be a lot more difficult on the economy and people around us.
So you're saying that you feel that the trickle down effect is going to be basically not a soft landing, like they've tried to estimate through their rate increases over this last year.
Oh, I think.
Are you feeling like?
Yeah, I think there's going to be a big thud. I think there's going to be a painful thud. I mean, when you think about rates, they affect the housing market first and foremost. And I think about every tradesman out there, swinging a hammer, pulling wire, dragging pipe. I think about every one of them and the amount of halt that we're going to have in the trades and building that's going to happen because of these. And you also have to take into perspective that pretty much everyone did almost every house renovation during COVID that they ever were going to do, for the most part, right? I mean, they either moved or did the reno job because they wanted better space. And now they're like, well, I have this better space, and yet I can't go move if I want to change homes because I'm going to be at 5-6%, 30-year fix, which is 2 times what I have right now. That's a hard thing. And all of a sudden, these trades, they're going to hit a halt. And every time the Fed raises rates, and we know that they're going to raise rates again. I mean, they're not at their 2% marker. The unemployment numbers aren't there. Rates are going to. I mean, the whole idea that the Fed's going to be cutting rates by the end of the year, with what they've said, that doesn't really match up. I know what people are saying and why they're saying it, and that's probably a lot more detail than the show needs. But I just think that
to get to the markers that they're declaring, we've got a lot more rate increases to go.
And this is, in our local kind of broadcast area, I think a lot of people would probably recognize this. But, I go down to Boston pretty often, and, one of the kind of easy eyeball indicators to me is how many cranes you see up. And there's fewer and fewer and fewer every time I go.
Yeah. I remember a few years ago, you'd go down there, it'd be like, it was Crane City.
The expansion's been absolutely incredible for these last 3-4 years, but it's starting to dwindle. And it's not, there's not zero, but there's nowhere near what there once was.
And there's going to be that, kind of like that people have to fulfill their contracts, right? So this work is going to complete, but it's the new pipelines, like the number of quotes. I'm talking to contractors, and they're like, yeah, it's definitely slowing down. Like they can see it. They're seeing it, and they're preparing for it.
They're actually answering their phones now.
Yeah, they're actually answering their phones. They might actually come and do the work for you now.
Wow, that's new.
So I think the idea that there's still going to be more rate increases is really what people aren't talking about. Is that the mortgage rates are going to get more and more unbearable. And I was talking to a mortgage broker the other day, a great guy. I thought, he really works for the buyer. I mean, it's really great to see that. And he's like, it's really slowing down. Like he's an optimist. So that scares me a lot.
Well, I love the leading indicator there, Dan. Pay attention to the skyline. See how the cranes are doing, how many cranes you got up, and that's a good indication of what's going on around you and how safe the economy might be right there. There's been some big differences in the markets, and to separate out the markets, we usually see, the Dow, S&P 500, NASDAQ, and as of this last year, the NASDAQ really got hammered, and that was the tech stock sector. Primarily, tech stocks is what the NASDAQ is composed of, in comparison to the S&P 500 and the Dow. So down 33% last year, and this year bouncing up 9% to finish off January. Some of the questions that people have is, why is this index so volatile? And is it a safe way for me to be investing? Or how safe is it for me to be investing currently? And one of the reasons that we see so much volatility in the NASDAQ is because it does carry tech stocks. And tech stocks are usually traded at a lot higher valuations than the rest of your, consumer staples, healthcare, real estate. And those are places that people will put their money to kind of hedge on a pullback in the market or a recession. Those are, recessionary kind of buys. So it doesn't have as much of an opportunity in the recessionary period to stabilize. But one of the things that we see also with the NASDAQ is that volatility over time usually pays off. It usually has a lot more gains available in it because it is in the tech sector. So that we're seeing something healthy, I'd say, as far as a mean reversion. We'll get there, what that means in a little bit. But we're seeing something healthy in that tech market to be able to see those gains come back.
I think about like the NASDAQ, it was like, early 2000s, it hit almost like 4,000. I don't know if it actually hit 4,000 or not. But, when you fast forward on it and you look at like, post 2008, early 2009, it was at 1,700 on the NASDAQ. Now, fast forward to today, it's trading over 12,000. But it was as high as like 15, almost, was it 15 or 16? I can't remember where it actually, I think it was like high 15s and almost peaked out at 16. But, you're looking at a 12,000 on the NASDAQ. The volatility of tech is horrendous. But why so much growth in 20 years? I mean, you think about the amount of growth from post 2008 to now. That's crazy growth. Just buy the NASDAQ. I think we have a lot of competing factors. And as Seth, you make some really good points. And it's like as you're talking, I'm like going through, one competing factor after another, one decision question that everyone has. Like we have people aging out of the working force, right? We have, 40 plus million people retired. We got another 80 million that are going to retire. It's like 40% of America is going to be retired. Unemployment, it's going to be, no matter how much they raise rates, it's almost still going to be difficult to find people to work because the number of people working is naturally declining because, the number of births are again down this year. It's like there's less people being born into the Social Security system to pay Social Security. That's a whole another conversation. But we have to continue filling the jobs. So where do you replace people? Technology, right? So then you're saying to yourself, okay, well, hey, listen, we saw this drastic turn down in the mid 2000s, and but there's going to be a massive pouring into the tech space too. So you've got these competing factors, and how they're actually going to play out over time over the next 20 years is going to be an interesting story.
I mean, looking at it in the short term, I mean, it's hard to project out that far, but in just kind of looking backwards as to what we're experiencing right now, of the 50 worst performing stocks last year, they're up an average of 20% right now so far, year to date. Right, and the best performers, the 50 best performers, are only up 2%. So you can see that there's definitely been a lean towards the tech stocks and some of the ones that maybe were oversold last year. But part of me kind of wants to think or believe that there's a lot of retail investors out there maybe looking at charts and trying to go through that whole notion of buy the dip. That was a big trend if you follow social media during kind of the pandemic days where everybody became a day trader in their free time.
Yeah.
So you wonder how much real analysis is going on, and if people are just simply looking at these charts saying, hey, you know what, this is going to get back to where it was because I don't know why, but they're going to go ahead and invest in that anyway, and maybe they're driving up that price and kind of getting a rally out of it when it isn't really pointing to, or there's no real suggestion of what the actual merits of the company underlying really are.
Yeah, I think that's a good point. I think to contextualize your statement, like the 50 worst performers are up 20% this year. They might only be up 20%, but they could still be 40% underwater, right? I mean, the truth is that most of those, probably all of them, are underwater still from the high and what last year was and so forth. So, I mean, I think when it really comes down to investing, I think really using people who know what they're doing when it comes to investing and really finding like the quality in some companies, which I think we want to talk about next, is really where it's going to play out.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Today we are talking about Sizzle or Fizzle in 2023. What is the prediction here in the markets? Because as of January, it has been on fire.
Sizzling for sure, so far.
Until you get fizzled.
Yeah, I mean, we've talked a bunch in some past shows about historical trends, right? A lot of people, will look to history to try and predict the future, and that's a big part of what we do. But, we do that with the understanding that not everything, repeats itself. But if you look back through kind of the history of big drops in the market, there's a lot of, material out there that would support in the following years that you have an equal or greater rebound. In fact, if you look at some of the biggest drops we've had back to 1937, 38.6%, 74, just about 30%, 2002, 23%, 2008, 38.5%. Each one of those big drops was, followed by at least a 20% return in the index. So that's a strong indicator right there that 23 will be, not only better than 22, but a significant rebound. And then we've talked a lot about the midterm election history, which is 19 for 19, shooting 100%, where every year after midterm election, regardless of which party wins, the market's up the following year into an average of 16%. Not every year has been that good, but that's the average. So, I mean, that's two strong indicators there.
I mean, that's 19 midterm elections. So that's, 4 years, right? Yeah. So that's, almost 80 years of history that's driving that statistic.
Yeah, that's not short term. And, in fact, the only years that we didn't get that kind of a significant rebound following, such horrific losses were 1930 and 31, which was the Great Depression. And I think, whatever doom and gloom you potentially read about out there, nobody's pointing to that.
Yeah, I don't think there's nothing about what's going on in the market that says to me like we're off to the races. Saddle up, buy as much as you can, and go there. I just don't feel that. And if anything, I think you take your selected profits and you put some money in your pocket and you look for another opportunity to enter either in that stock again or some other asset that's been overbought.
It's something else I came across. Berkshire Hathaway, Warren Buffett, his investment company, they're sitting on $88 billion of cash right now, and that is by far and away the largest cash position they've ever had.
Yeah.
I mean, these guys like to buy. I mean, they jump into stuff, but when they do, it's not small. But they're clearly poised and waiting for something.
Yeah, I mean, there's a number of different financial institutions that I think the thing is a lot of people think that the market will be up, and I think that midterm election statement, I generally kind of agree from November 1st to November 1st, which is that statistic, right? So we're already 3 months into that scenario plus. I really do think that we probably will be up from the November 1st later. But we're already a third of the way through that.
Right.
Right? But I don't think we've seen the bottom. I really don't. I think when you look at the S&P numbers, like you could buy stocks and you can manage through this, but I don't think you've seen the bottom. And there's a lot of investment people out there, a lot of firms, a lot of financial, companies that all they do is predictive analysis that just say, we have not seen the bottom.
Yeah, I don't. We don't. There's no way of knowing which of these indicators is going to pan out. We've spoken at length in some prior shows about how there really are some competing historical facts out there that trying to project into the market is really difficult to do, and we certainly don't have that crystal ball. But we do have an approach to doing well in this market, and we do have a type of stock that we look for, and I think that's going to bode well. It's really about trying to find that quality what's out there.
Yeah, I think when I don't know about you guys, but I really feel, and I don't, some of this stuff plays into when we don't try to time the market. I mean, I think that's one of the things. We definitely take a hybrid approach that a lot of people don't take. You deal with people who we've done shows on. Active and passive investing and so forth. And, if you're not familiar with that, it's something you can definitely, listen to one of our past shows on. But, the concept of just passively sitting in the market and allowing it to do what it does, we generally agree with that. But we do have some fundamental triggers that say we need to be out. And that's bode well for us, very, very well. In times when the market, like our S&P holdings went to cash back in April, and we've played in and out of that a little bit. So we take an active and passive approach to it. So when certain things happen, we turn on the active things like, hey, listen, we believe there's an efficiency to the market. We're going to carry through. But when the market becomes inefficient, when crazy events happen and things feel like they're off the rails, there's a portion of us that just goes out. And that gives us, we want that volatility out of our portfolios. And we've done really well with that. And I don't know, based on some of the fundamental work that we do, whether we'll be in or out during these certain times. But I do think that in the S&P piece, and I have a lot of data that backs this, is that we could be really looking at, below 3,500 on the S&P. I really think we could be seeing that in a range that, might even be half of, 32 maybe. Who knows how deep it goes, but I don't think that this 4,000 range of the S&P is realistic for the whole year. But that being said, the market's moving up and down, whether we're north of the November 1st S&P of last year to November 1st this year, I do think is going to be positive. How deep this swing goes is going to be, what is to be told.
Yeah, there's a lot of different perspectives out there, really depending on what kind of an investor you are. That passive investor that Ben was talking about, where you just buy the market and you hold on and you just you let the market do whatever it's going to do, or you're active and engaging in that market. Some of the people that I have enjoyed following do have a similar perspective, where they're looking at charts and they're kind of taking, a lot of the emotion out of the investing and purely looking at what does the chart tell us. And some of the things that they've been talking about is the market returning back to that 2008 level, which, if you're taking a look at the NASDAQ right now at about 12,000, would bring us to, where would be right around 8,000 on the NASDAQ. And on the S&P, that would be returning back to a level of around, we were at 23 on the S&P. And right now we're at around 4,000. So, almost half And what are they looking at? Purely, they're looking at like, where does the support in a chart happen? Where does the pullback in the support? And some of those have been big pullbacks. And in that larger picture, that, you know, going back to the S&P for the last 20 years and looking at that, that's kind of where they're coming from and saying, well, it's likely that we'll have something like this happen in the S&P or the NASDAQ or in our markets. And so that's one perspective. And how do we take a look at that?
I think that's great. I don't want to forget this, but like, I think that's a great point, because I think people don't think, like, you say those numbers, they seem unrealistic. Like, it's like, how could we go that far down to 2,300 on the S&P? But these things have happened over and over and over again in time, and it couldn't happen at a better time than where interest rates are now with the fixed rates. Like, Dan, you were talking a few weeks ago about a fixed annuity paying, you know, almost 5.5% over a 5-year period or something like that. I mean, what better way to park your money in cash if this craziness is going to happen and you're walking through the retirement door? Sorry to take your thunder, but I'm like,
no,
you know, it's it. People don't think 2,300 on the S&P could happen. I don't think it's going to happen. I'm not as negative on the charts as those, and I know what you're talking about, but I do think the low 3,000s. I mean, I see 3,200 on the S&P. I mean, I'm probably going to buy in more, you know, on the S&P holdings alone.
Yeah, I mean, it's dramatic to think that that's even possible, especially on the heels of last year, right? You know, that's talking about another 20% cut, you know, from where we stand today, more than that. So that's, you know, that should be significantly concerning. But there are opportunities out there to, you know, through various investment options to kind of protect yourself and make sure that, you know, at least that money that you have to have for retirement is in a position to not suffer those losses.
And that's going to be some of what we're talking about next. We're going to take a quick break. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Folks, it is so much fun for us to bring you Money on Tap. My name's Seth Kressman, and I am one of the hosts here at Money on Tap. I'm also a financial planner. That's what we do. That's what Ben and I do. And the fun part is we get to have this radio show. We talk about important things that we think you need to listen to and be aware of to help raise the bar as far as your financial literacy. It's a big part of what we're trying to do here. The other thing that we're doing here as well, as financial planners, we are welcoming you to come and call us and to join us at Brayshaw Financial Group. Experience what complete wealth management looks like. Let's take a look at all sides of the issue, get a three-dimensional perspective, and put a plan around your next step. It's so critical, and so many people just leave this part out, and then they find out later, oh, if I only would have known. Hey, don't let that be your story. Give us a call at 855-226-8551 or info@yourmoneyontap.com. If you have $250,000 of investable assets today, our plan is free to you. We think it's important for you to know the facts and have a playbook so you can have a successful retirement. Give us a call at 855-226-8551. Thanks for listening.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about Sizzle or Fizzle in 2023. The market over the last month has been up and up big, which is a really interesting conversation to have on the tail of what looks like a bear market. Is there more bear to come? Is there more bull to come? We were just talking about charting the S&P, charting the NASDAQ. What does that even mean? What we're talking about when we take a look at charts is trying to understand different movements in the market. And if we take a look back, over the last year, we can see where the market peaked, rolled over, and then dropped. And that has happened several times in our market. One of the most significant was 2020, going back into 2008. So there's the history of what the market has done, and being able to see that helps us to kind of prepare ourselves a little bit. We're optimistic. We love to see the market go up, and we're investing to increase, to be of increase. That's what we're doing here, is multiplying money. And that's what we're called to do, frankly. So in a in the market that we're in right now, do we, say, hey, this is great. We're seeing the market turn around. Now we're going to go ahead and pull all of our money and put it back into the market, or put it back into the NASDAQ, both of which are the market. Or do we take a look at this and say, okay, are there other opportunities for us to really protect our clients from the possibility or the high likelihood that the market has more losses in the future before it has the returns? And, in this market ahead of us, I think what we're seeing right now is a lot of the buying action, a lot of the optimism, a lot of the mean reversion off of the recent pullback. And how long does that last? Frankly, we could see the market go up over the next year and have that 20% return over this next year. But does it beat the previous highs of 4,500? I don't think so. I think what we see is we have a new ceiling there, and it's going to have to be some really positive influence in our economy for a while in order to see us break through that ceiling. And what the markets will typically do is they'll touch that ceiling and then they'll pull back. And I think we're going to see a lot more of that, bumping up against that ceiling, pulling back, new lower lows. What that news is going to be, we don't really have. That's the part that we don't know. But there's things out there that are out of our control, out of our understanding, that will affect the market. Right now, it doesn't look like the Fed increasing rates is going to be the trigger for the market. It doesn't look like the unemployment rate is going to be the trigger for the market. So in the meantime, how do we be successful through a market that just isn't telling us go, go, go?
I think there's two things, well, at least two, but two that come to mind for me. And it kind of really depends on where you're at in life and which asset we're talking about. If we're talking about those retirement dollars that you just need to plan around and have to have, and you're nearing that point in your life and you've experienced this loss that we just went through, there is some good product out there that, would allow you to participate in the market upside if and when it occurs, but also put a safety net under the value that you have today and guarantee you no loss going forward based upon negative market performance. And if it's money that you intend to take out as an income stream at some point down the road, we can actually guarantee some growth between here and there. So that structure of contract exists, and that's something that we advocate for in the right opportunities. But if you're more of a long-term investor and you want to stay fully in the market, or you have just a particular asset in mind that you want to keep in the market, this is a time to be, I think, really selective. And you got to be looking for stocks out there that have, a track record of success, a track record in particular. This is one indicator of paying a dividend and increasing that dividend over time, through different market cycles. Because I think that's where, regardless of how the stock price fluctuates on a day-by-day basis, you can get some predictable income off of it. And with the recognition that, you're invested in a company that's got a track record of success and actually knows how to make money in every different kind of environment.
I'm constantly running filters. I'm always looking for things and spikes and changes. And, a lot of the things, there's so much predictability to fundamentals. I think that's what we all go through this. And I love how we get together as a group and, we debate through these stocks because there's 1,000 different places, 10,000 different places to put money for our clients. And I think, when we narrowing it down to 2 or 3 or 4 places that we want to put money, it's hard, right? I walk away from some of the meetings like disappointed, like, oh, I really wanted, I thought that was, and we trust each other. We work through this stuff, but we're talking about degrees of, finesse, right? I think that's really where it comes to. You're looking at PE, you're looking at beta, you're looking at potential alpha, you're going through these, relative strength issues, and you're looking at all these different fundamentals of, all the stuff that's moving and around. And then you look at the overall market and you're saying to yourself, okay, well, how will this stock or this, general, genre of investments actually perform in a market that's, moving like this? Like, are you going to buy, a blue chip value stock when everyone's going tech? It's like, but the thing is you got to really figure out where you want your money. And I always like to put my money in a company that has real profit, and make sure that there's just an actual profit margin to it. I think if you go into a company, irrelevant of how good of an investor you are, and you find somebody who has a solid profit, and the company name, it's like there's a lot of reassurance to that. Like, even if the stock goes up and down, they're making money.
And that's got to be a real litmus test going forward. Is at least in volatile times like this, when the cost of money is unpredictable, and that's what the interest rate environment is telling us. You need to kind of build the backbone of your portfolio and your investment strategy around exactly that. Companies that know how to turn a profit.
So it's interesting. There's a lot of what you're saying that really reminds me of buying real estate. And that's probably the most, to me, the best representative of the kind of equities that we're talking about. When I say real estate, people probably typically think of, a house or maybe a rental, a fourplex, something like that, right? But real estate, one of the first things that you're asked, or what's the most important thing about real estate that you're asked, is location, right? How many times have we heard location, location, location? And so one of the things that we can do inside of the equity world is kind of pull it apart and take a look at these factors. Like, what neighborhood is that in, right? Where is that a sector of the economy? With what we see in the economy happening now, right? Is this a good place for us to buy and hold on to? And does that location have cash flow? Is it giving us money just for holding on to it in that location? Is it profitable? How much do they have in cash? What's the balance sheet look like? So these are investments. And a lot of people in the market, right now is a great example with the NASDAQ just kind of going on a rip. It's, kind of more shoot from the hip. It's like, oh, hey, there's a cheap property over there. Buy that. There's a cheap one there. Buy that.
That's exactly
and
right.
It doesn't really hold much weight under, a stress test. And that's what I feel like we're about to see right now, is we've kind of gotten a glimpse of some significant things passing through our market. And we're about to see, I think, the strength and the might of our baby boomer generation really doing what it's been designed to do, which is go towards income, buy income properties during recessionary periods and during retirement periods.
Sorry, Seth. Yeah, so I'm totally agreeing with you. I know we're running out of time here. I had somebody contact me about a stock we had put into one of our portfolios, and they said, "Man, I don't know. I don't understand why you're buying the stock." I'm like, "I'm not buying it for today." Like that was one of the things. Is like, it has a nice yield. I know it's a strong company. I know I'm not going to buy the bottom. Like, if anyone thinks we're going to buy the bottom of any stock, they got to be kidding themselves. It would be pure luck. Like, we're getting into a company that we think over time is going to be significantly profitable. I think about Warren Buffett buying Oxy. He's like, oh, I'm never going to. He just keeps buying and buying and buying. He's never going to get the bottom. And then he stops buying to let the stock settle down from all the buying they're doing. And then they start buying again, So it's just like, we want to sit there and buy. I want to take a position, because I think in 2 or 5 years, I don't necessarily want to buy a stock for 6 months. Like, that's a lot of work for us to do, to just invest for 6 months. I want to buy the winner over the next, 5 years. That's going to pay us 3 to 5% to hold it. So Seth, you're dead on. And I think for our listeners, you're not going to understand every company we buy, but you're going to be able to find them. They might even be a household name 80% of the time too.
Folks, you have been listening to Money on Tap. You can reach us at 855-226-8551. We've been talking about Sizzle or Fizzle in 2023. Hopefully, you are a successful investor or becoming a successful investor. And that's what we're here for, is to help you take that next step. Thanks so much for joining us this week. We can't wait to talk to you next week. Take care.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.